Hi, everyone. Sorry, I'm a couple of minutes late. Just a couple of IT issues. Okay, welcome everyone to this, including Haley from Australia, I believe, and Mukesh from Lockdown Leicester. I love the new name for it. Maulik, how are you as well? We've got Sue from Vienna. We've got a global audience. Let me know you can see and hear me loud and clear. And also, one of the things I'd like you to do is let me know which part of the world you're from, please. Okay, that's really important so we can kick off. I've just been updating some of the latest information I'm going to cover. Let me just share the screen and we just get on with it. We just get on with it. Okay, here we go. Screen 6. There we go. All right, so you should be able, great, loud and clear. That's what I love to hear. I'm going to update you on what we're seeing in the markets, bang up to date right now. In terms of, what the Chinese are doing in terms of cooling stock. Should we be getting in? Should we be looking at banks? They've had the worst quarter since the financial crisis. Does that make them good, bad, indifferent? Do we stay clear since they've been doing so poorly? Why would we not go for better quality companies? Okay, what about China and US sanctions? What are we going to do about that? Does that mean we stay clear of Chinese companies, or are the Chinese the ones who are moving ahead out of coronavirus and the best stocks to buy? And if we are going to buy them, surely we want the Chinese companies listed in the US. But hang on, sanctions. Does that mean we stay clear of them? How do we make sure we don't make any of the biggest mistakes? Okay, and if the ultra rich have lost out in the recession, how do we make sure we can outsmart the super rich? Is that even possible? So we're going to look at a whole bunch of data that I'm going to give you there, and then we'll drill down into some individual stocks and information there as well. I'll give you a list of what I own at the moment, both for myself and for my son, and how we look at what it is others are owning, including hedge funds, and what do they own, why do they own it, how do we decide what we should be looking at as well, and what are the bigger markets saying about these things as well, the big banks saying about it. Okay, so let's get on with it straight away. Let me get on with it straight away. I've been doing this for 20 odd years. As somebody pointed out recently, your hair's gone gray, what's left of it. Okay, that means I've got a track record. I've got a track record of getting it right. I love my own show on Bloomberg called Making Money, appropriately enough. All right. And I've still been working with Sally right up to now on the BBC and in between CNBC and all the rest of it. I'm going to give you all the best bits from all of my books. Okay, as well on here. We've got quite a few Australians. I'm absolutely delighted. And we've got people from France as well too. I'm going to make sure this is global. This is relevant to you whether you're in Australia, the UK, Europe, or America as well. All right, so got the whole lot. I will give you all the best bits of the information from all my books, as you know from my webinars. This was something which I shared with my private Telegram group. I'll tell you about that later on. I think on the 16th of June. There you go. On the 16th of June, ripe for rally, and everyone thought you're insane. How can NASDAQ, tech stocks? Never mind that. I've been banging on about it for about the last 10, 12, well, 20 years actually, which I'll prove to you in a second. So whether it's 20 years or 20 days ago, my job is to get it right and make money. So what is it that we like? How do we do it? How can we get it right in the markets? And by the way, that's where the NASDAQ is at the moment. All right, we'll talk about the UK markets and global markets in the last 5 years. That's what it's done. It's doubled as an index. When an index doubles, you can pretty much work out that individual stocks composing that index will have increased even more, significantly more as well. First things first, okay, a bit of admin. I have no conflict of interest with you. I am the founding CEO of a hedge fund which has expanded into private equity. We are not open to retail clients because the law says we can't be open to retail clients. Our investors are pension funds, high net worth, sovereign wealth funds. And by high net worth, some of my investors are people like the founder of New Look PLC, founder of Cobra Beer, and so on and so forth. I have no conflict of interest with anybody on this webinar, all right? Just so you know, and I want you to know that so that you know that I'm not trying to tell you to go long the market because it's good for my fund management business. I couldn't care less. If the market falls, we still want to be able to make money. And by the way, I'm going to tell you something useless and useful. I think there's a 50% probability the market is going to fall, a 50% probability it rises. Yeah, I know what you're thinking. Well, might as well switch off now. Fat lot of good you are. My job is not to be a crystal ball. My job is to make money whether the market rises or falls, okay? If it falls and my stocks fall for a short while, what will happen is I make sure I've got the kind of companies which won't fall as much and will recover a lot faster than the others. Market falls only delay my ability to double money, and that's the point. How long is it going to take me to double money? Is it going to take 3 years, or is it going to take 5? If the markets fall, it's going to take me 5 years. If they don't, it'll take 3. Some companies, like the recent purchases, Best of the Best and Inovio, doubled in a month. I didn't expect that. I do low risk. Despite what you might think with some of those returns, I do low risk because the trick is not trying to make money when the market rises. Any idiot can do that. The trick is trying to keep the money when the market falls. And the only way to keep money when the market falls is not trying to time it, as I'll prove to you. It is trying to make sure you've got quality companies. Another piece of admin, okay? I do not know the individual circumstances of every person on this call, okay, on this webinar. This is not personal advice. It is not stock recommendations, because within 5 seconds of this webinar ending, it might all be irrelevant. Within 5 seconds of this webinar ending, for all I know, a news item comes up and all of a sudden something completely different is the case, okay? Where's the bubble? There's the NASDAQ, right? Bang up to date for you. So that being the case, I want you to know these are not personal advice. They can't be by its very nature, okay? And it is not an invitation to go and buy some of the stocks that I'm mentioning. It is educational, so you understand how to do it. And I will give you not just my education as a fund manager, not just from my 18 odd books, but also from the whole nexus mosaic of networks that I have, things crossing through my desk, including the research that I get. And so on. Okay, so that's included in this webinar. So there's your checklist. Please close the doors. Make sure nobody's using the broadband, otherwise you won't be able to see and hear me properly. And one of the other things I want you to do is grab a piece of paper and a cell phone so you can take pictures of some of the slides, because some of the slides will never be repeated again. They're proprietary, they're confidential, they're of this time, so I will not be repeating some of them. So make sure you've got a phone to take pictures. If you haven't done so already, do connect with me on LinkedIn. It's completely free. LinkedIn is owned by Microsoft, and it will allow us to communicate with each other. That's what LinkedIn does. It will allow you to see some of the work and some of the track record and awards I've won, blah, blah, blah. Some of the work I do with the UK government, who very kindly help me promote the United Kingdom and technology, and that's what I'm going to talk about as well, and bring those technologies from around the world to the UK. So you will see some of that as well in this. Now, what are we going to do? I want to make sure every single one of you on this webinar has a disciplined process. Save you time and to get things right. Save you time, get things right. That's all we want. Save time, get things right. Okay, you can write that down on that pad of paper I told you to grab. How are we going to do it? I believe in discipline, I believe in process, and then I believe in smelling the roses and playing with my son. That's what I believe in. Those are 3 things I believe in, all right? So how are we going to get the discipline process? You get from a billion sources, whether it's social media, articles, or whatever else, a whole bunch of company names. How do you decide whether or not to put them into your portfolio? So I'm going to give you 7 very simple ways of generating name ideas, and then I'm going to give you some free tools and software to show you how to evaluate those. I'm going to show you that there's only 2 types of companies: quality or performance. Let's assume for the moment all companies are performance. What does that mean? That means we will set a time target, not a price target, because why would I want to cap my profits? Why would I want to constantly be watching the markets to see if it hits a particular price target? Why would I want to not only try and work out the right company, but the right price? That's trying to guess 2 things. I don't want to do that. Okay, for instance, I bought Inovio and Best of the Best, as you'll know if you were following me in the last webinar. From about a month ago, they doubled. I didn't know they were going to double, right? If I had a price target of 20% rise or 40%, I would have missed the other 60% rise, okay? So my point is we have time targets. What evidence do I have that time targets are better than price targets? Well, I'll show you the research from Goldman Sachs on what they tell their wealthiest clients, and they give them, guess what? The wealthiest clients at Goldman Sachs Asset Management, which by the way, is the chairman of Goldman Sachs Asset Management is Mrs. Sheila Patel. I'm very proud of the fact that it's Mrs. Sheila Patel. Anyway, that's besides the by the by. Goldman Sachs Asset Management set a time target. I want you to set a time target and think of those. What's our stop loss going to be for our performance stocks? What are the tools? And then how should we decide whether we buy, hold, or sell? domestic stocks, funds if we might want them, and US and global stocks. Let's say US and global. So if you're in Australia, you want to have a global group of companies. Now, I'll tell you why. I want to interview 8,000 global companies, UK companies, Australian companies, American companies, 8,000 to pick the best 14 to manage my son's inheritance. Okay, it's as simple as that. It's as simple as that. I don't want to interview just the 300 largest UK companies. Why would I restrict myself to 300? It's a big ass world out there. Why would I not filter 8,000 to get the best of the best? If I'm looking at 8,000 global companies, I'll get the equivalent, stock equivalent of Nobel Prize winners, PhDs. And after all, it is my son's inheritance that I'm talking about. So, you know, that's why. Now, once we do that, as I'll show you in this webinar, once we do that activity, once we go through this process, and I've updated it from the webinar 2 days ago, so I'm going to show you some of the latest updates on all of that, okay? Once we do that, and I'll do it whilst we go on air, because sometimes people ask me, is it live? Okay, so once we do all of that, we need to, from all of this global universe of stocks, you know, the Dow, the S&P, the NASDAQ, and FTSE, CAC, whatever, Nikkei, Hang Seng, everything else, we need to, off the top of all of that, then need to decide, okay, let's say we've got 15 stocks. Assume for the moment they're all performance stocks, what I call performance. I'll tell you what my quality companies are. I don't believe there's 5 in the world, but I'll tell you those later. Let's assume everything's a performance stock. The market can only go up, which is the blue arrow, or it can go down. The market can only ever do one of 2 things, can't it? It can only go up or can go down. And we've only got 3 decisions to make, buy, sell, or hold. Let's simplify things. Okay, let's be methodical. If it goes up and it's a performance stock, the question is, has our 12 months run out? If it hasn't, we wait. Now, some of you might say, well, Alpesh, wait a minute. What if it goes up 100% in a month? Can't keep going up 100% every month. That's a nice problem to have. Let's leave that for the Q&A section. Let's leave the little complexities and nice problems to have for later on. For now, let's just say performance stock, 12 months, right? That's it. You're not going to buy more of it. Why not? Because it's a performance stock. It's not a quality stock. Let's say the market falls. If it falls, and if it's a quality stock, and I'll give you a clue, one of my quality companies is Apple. All right, and I'll explain why it's one of the 5 quality companies. Hey, they've got a monopoly and they've got £1 trillion in the bank, but I'll explain why later. The only things I ever buy more of if the market falls are quality companies. Why? Well, as Warren Buffett put it, if Apple drops 20%, what will you do? He said, I'll buy more. Everything else, you never add to losers. Write this down. Losers add to losers. Losers add to losers. So we will never add to a losing position, right? If 12 months are over, we reevaluate and we say, oh, we've got a loss, get out there. If our stop loss has been hit, which is typically 25%, but you can make it 30% in more volatile markets if you wish, okay, then we've got out before that as well. I'll bring all this together and give you the full strategy in a second, right? But these are important rules. Now, you might say, well, wait a minute, Alpesh, what if it's down 20% and it's only been a month? What do I do? Still wait, okay? Because many a company has dropped 20%, then risen 50 before the year end is out. 12 months, stop loss 25%. Right, now what do we do about the rest of them, and how do we find out the tools and the strategies? So we've got a methodical approach so that if the market falls, our stocks don't drop as much and rise and recover more quickly. How do we find those? After all, how do we find those given the fact that there are so many factors by which we can measure companies? For instance, valuation is one, but we know that doesn't work all the time because a company might be undervalued for a good number of reasons. It might be rubbish. That's why it's undervalued. And not only that, which valuation metric are we going to choose? The price to its profitability, earnings, in other words, or the rate at which the profits grow. Journalists love this because it's simple, like the journalist. Or price to book. What would happen is if you sold all the assets. Or price to sales, its turnover. Maybe that's more important. Who cares about profits in a technology world? Or discount cash flow, the net present value of all its future incomes. Because after all, an asset is only worth today's net present value of everything you might earn from it in the future. That's how people value buildings and rental income, after all. So what should we use, and which one of these is right? And what if none of these are right, and they all vary at different times? And surely we don't just want undervalued companies, because a company can be undervalued for a long period of time. We want them to be growing. But again, growth has 2 problems. There's many different ways of measuring it, and a fast-growing company might be about to collapse because it's overvalued. So we actually want an undervalued company which is growing fast. But we're not going to be screen slaves looking at all of this data constantly, are we? And surely we want them to develop, to provide us income, some kind of dividend yield, because then if it falls, it can't fall too far because its yield would increase, and therefore it must have a floor to the price. People will come in and swoop into it, and that gives us some protection. So maybe we want some dividend. But is there a correlation between high dividend yielding companies and longer term performance? What about undervalued companies with strong growth and dividend yields? Is there a correlation to performance, especially in falling markets? Are we more likely to be protected and more likely to rebound quicker? And especially if we're looking at 8,000 companies. And don't we want to make sure there's some momentum as well? After all, who the hell wants to have missed Amazon for the last 16 years? Okay, maybe momentum is the right answer. What's the answer for momentum? Is it media buzz? We can do that now. There's tools out there. Or is it chart patterns? Or is it trends? And surely that alone is not important. And sometimes we want to get in even when a stock hasn't got momentum because it's got nobody else has seen it. We have. Okay, and that's not all. Why don't we just go for statistical analysis? Too much data. Why not just go for statistically a certain company tends to outperform and it's low volatility. It tends to consistently outperform. We've got that data. Why not just go for that? Screw everything else. What does it matter? If it's always outperforming, why not just rely on that? Well, what I'm going to teach you in this webinar is why each of these factors is equally important. Actually, some are more important than others, and I'll tell you what, and I'll tell you, even though they vary over time, we thankfully, as private investors, because we're not running hedge funds, because we're not managing money for other people as private investors, we only need to be approximately correct. We only need to have 15 equities in our portfolio, and I'll show you why, okay? And we only need to roughly get 20% if we're looking at just the UK or our domestic market, and 40% if we're looking at America, because American markets tend to do twice as well as anybody else, as history shows. So if we're looking at, let's say, 40% per annum, we only need to be roughly right. It doesn't matter whether it's 39% or 41. And there'll be some years where it's a lot less because the whole market's dragged us down. There'll be other years which will make up for the poorer years. So what is it we're going to look at? What are the specifics and how do we get all this information and stuff? Look, one of my mentors, so 25 years ago, I approached some of the world's leading traders and investors. One of the people, global head of foreign exchange at Salomon Brothers, was Bill Lipschutz. His boss was Warren Buffett. That's how I got into the whole shebang. I produced one book for Financial Times. They asked me to produce more. It meant I did a lot of research. It meant I got to know the right people. All of these things go into your sort of funnel that is your brain and head, okay, as well as then setting up my own fund. So I'm going to share all of that with you. The one thing I can tell you with all that information and knowledge and having met the billionaires and people who've done it before me and then copied them to get to closer to their position, let me tell you now, if you want to gamble, leave now. If you want to double your money by tomorrow and you think you're going to get some hot pick without the risk associated with it, I can give you hot picks. The risk is so great that I'd have to tell you, yeah, you might lose all your money in 24 hours. Do you want that? You'll go, oh, okay, no, keep your hot pick, Alpesh. Yeah, thanks very much, mate. If you want to double your money by tomorrow, please leave now. In other words, and I've written this in my Financial Times columns, the shorter the time frame you give yourself and the bigger the return, the greater you are to being a gambler. The more time you give yourself, the lower the return, less so. We want to make sure we're on that efficient curve where we've got the maximum possible return in the shortest possible time so that we're neither gambling nor are we being sort of, relaxed about it and saying, I'll give myself 100 years to try and make 1%. Okay, that's what we'll do. That's what we're going to do. This is where we are so far this year, by the way. And let me tell you something. The blue is NASDAQ. The blue is NASDAQ. Okay. Now, that's up 20% so far this year. The black is the UK market. That's down 20%. Which would you rather be? This is why I say we want to interview global companies. I'm not talking down the United Kingdom. Far from it. I'm a proud British citizen. What I'm saying is I want my fellow Brits or Australians or French people living in France, whatever, not to just look at their domestic markets. You're never going to get wealthy. One of the reasons the Americans are so bloody rich is not because of some racial bias of superiority. it is because they invest in their domestic market as everybody else does. And their bloody domestic market, whether it's self-fulfilling prophecy or because it's access to capital or whatever, tends to go up. Guess what the great thing is? Without moving countries, you can piggyback on that. People don't. They have a huge bias to their domestic stocks. I'm going to prove it in this. So what happens? Well, British people, whilst having the opportunity, or Australians, to make money and have Americans working for them at Apple and Americans working for them at Microsoft or at NASDAQ, making a 20% return, instead, they get a 20% loss. Time and time again. By the way, if you think that I've just picked the year to date as some kind of illustration to prove my thesis, try any rolling 6-month period going back to the end of the Second World War. And my thesis is proved right time and time and time again. Now, there's a difference between a thesis, an argument, and proof. It doesn't mean in the next 6 months or from this day onwards forevermore, NASDAQ will always outperform the UK. But that's a thesis I'd rather put some money on. Okay, I can't prove the future. Nothing is guaranteed. But I can certainly say that I want to interview 8,000 global companies and not just the British ones. And this is one reason why. And in stark contrast, if this does not give you a slap in the face and say, hey, can I afford to retire? Well, going by what's been happening in your pension fund, given that's probably down 20% year to date, no, you cannot. But if you're American, howdy. Can you afford to retire? Looks like you can. All other things being equal, same amount of capital, an American and a Brit, same amount of capital, same amount of time, no difference other than the markets they're in, the American will end up richer. And it's not racial profiling, okay? That's why it happens. So how do we equalize that? We don't even need to move countries. That's the beauty. By the way, NASDAQ's already erased loss. Now you might say, oh, NASDAQ technology, that's never going to last. Alpesh, your thesis is wrong. Well, I'm not saying invest in NASDAQ. I'm going to say we're going to interview 8,000 companies. What is it that most recently has worked well for the NASDAQ, but at other times has worked well for other indices, other countries, other companies? And there are some British companies in there. There are some Australian companies in there. Okay. This is the 1 month global performance of the of companies around the world. Every single one of these companies is part of the 8,000 we're going to interview. And every single one of these companies is quoted on a Western stock market. Now you might say, you biased person, why do you not trust the Chinese Shanghai stock market? Then we'll go into that some other time. I want my companies to either be listed in the UK or US, because I know those exchanges, or Australia if you're Australian, but it's a bit niche if you're not. Okay, so there's 8,000 companies in the UK and US, including French companies which are listed in America, including British companies listed in America, including Chinese companies like Alibaba. This is the 1 month performance, but this is backward looking. What about now, Alpesh? What about now? What out of those are we going to look at going forward, Alpesh? Which one of these now going forward? Okay, do we examine? Do we focus on? Of course, we know IT's been doing well. What else has been doing well? Consumer discretionary. Do we want to go into consumer discretionary? And which part of consumer discretionary? Okay, do we want to be part of within there? Oh, internet and direct is not really bloody consumer discretionary after all, is it? And which one of those companies was it? If we drill down, how are we going to do it? How are we going to do the maths of it all? Okay, so that's what I'm going to teach you. And by the way, this is a 3 month performance on the US. And by the way, in the last 3 months, any of your stocks up, say 26% or 41%? I'm not even going to argue with people who have been telling me for 16 years, is it too late to get? It's too late to get into Apple. It's too late to get into Amazon. They've been telling me for 16 years. And thank you very much. Okay, or Alphabet, or Google, in other words, Alphabet up 25%. Facebook, who'd have thought it, 45% up in 3 months. Did you stay on the sidelines because you thought the market's going to fall? Even if there's a 50% chance the market's going to fall, I'll show you why it doesn't make sense to try and time that, because if you get the 50% wrong, you miss out on what you're seeing on screen. Which of these do I own? Well, what I consider to be quality companies, I mentioned quality, I only consider 5 companies to be quality and monopolies, and the rest are performance, and obviously the 75% of my portfolio is in performance companies, so I'll go through performance. But the quality ones, because they're monopolies, because they've got cash, and because that's where money flies to. Now, why did I pick 5 quality companies? Well, I started doing it in 2008 when I realized that there's a flight to quality when there's a market crash. Where's the flight to quality? The flight to quality isn't to cash. The flight to quality is in equities who have got trillions of dollars of cash. Why? Well, because they've got trillions of dollars of cash and they can still generate a return more than a bloody bank account can. Which were those companies which did the best during the financial crisis and thereafter? Because they had the most money and the ability to generate money no matter what. Microsoft, Apple, Facebook, Alphabet, and Amazon. Those are my 5 quality companies. Now, some of you on this are going to say, not quality anymore, Alpesh. Fine. I'll speak to you in 10 years when you won't be retired still. Okay. So what about the performance companies? The performance companies are everything else. And how do I decide and pick on those? Actually, Alpesh, why don't you just put all your money in Amazon or all your money in Microsoft or in Apple? You're right. I will continue regretting that all my money is in not all those, but then that wouldn't be very diversified, would it? Okay. What about the others? Let's focus on performance. And regardless of what type of recovery it is, my stocks, whether it's V-shaped, U-shaped, swoosh-shaped, W-shaped, L-shaped, oh, Z-shaped. Somebody actually did say Z-shaped. I took the piss when I said it's going to be a Z-shaped recovery, but actually, apparently, it can be. My stocks have to be the type which don't fall as much as the others and recover quicker and more than the others. That's what I want. That's what I want. I want a hockey stick. I can't prevent my stocks, no matter how good they are, from falling when the rest of the market falls. But I want them to fall less and recover quicker. I want them to be tick-shaped. I want them to be like that. Okay. John said you don't see Tesla in the list. Probably not big enough to be in that list. If I promise to give you great content, can I, in the last 10 minutes, tell you something we spun out from my hedge fund? Can I tell you about a program my hedge fund spun out right in the last 10 minutes? You don't have to stay for the last 10 minutes. Can I tell you right in the last 10 minutes? I ask your permission. You can leave before then if you wish, but I always ask people's permission. So given that we think there's a 50-50 chance that the market might rise or fall at any bloody time, should we even be trying to time it? Should we be in the market? Why don't we just stay all cash and then go all invested and then all cash, then all invested? Okay. Bloody hell, I get a workout on these webinars. Well, this is the reason. The S&P 500 without 2020's best 5 days, right? So that blue's the S&P 500. And then white is if you missed the best 5 days. Can you see what would have happened? You'd be 30% poorer. So all these people, I've got a whole bunch of people saying, oh, but I'm really kicking myself. I didn't listen to you. Even though you rightly said the market's got a 40% chance, no, 60%, I think I said at one stage, of hitting March lows. You still stayed in. And I thought, nah, if he's saying 60%, surely it makes sense I should be all in cash. Well, if you were, this is what happened. Because you forget the flip side, that, yeah, it might also have risen, which it did. And even if it didn't rise, any falls would have been quickly recouped by having the right equities. So we're not trying to time it, because I'd be down 30% if I did. And guess what? There's a whole bunch of people saying, oh, God, I wish I listened to you because I'm 30% poorer. That's the opportunity cost. That's the opportunity cost of staying out, okay? And it hits you very quick. You don't actually notice it. The thing with opportunity cost is you look at your portfolio, but you've got no comparison. You can't compare it to mine because you've only got your own one to look at. And you don't realize that every day, every week, every month, every year, you're getting poorer relative to somebody else, Okay, so my job is to make sure you understand best practice. But then again, hang on, Alpesh, you're being a bit bullish. Apple shuts 10% of US stores again on virus fears, with 14 in Florida. And whoa, you're getting a bit ahead of yourself, Mr. Patel. You're trying to talk everybody into being constantly investing. No, I'm not. I'm trying to talk people into investing in quality always, because it's not about the money you make when the markets are rising. Any idiot can make money in rising markets. It's the amount you get to keep when they fall, and they will fall. But it's about keeping them and making sure we're still in when the markets have the best days, which usually come after really bad days, right? So we're not going to be able to perfectly time with that crystal ball in any event. So how are we going to do it? What are we going to do? And maybe there are companies like Apple or Tesla and all the rest of it, right? And maybe we look at their suppliers. There's a lot of ways of generating ideas. These are all the suppliers to Apple, 187 suppliers. If you wanted to, by the way, if you want to replicate Apple, all you got to do is contact each of these suppliers and say, I want you to make for me what you make for them, and subject to contract law, you might be able to. By the way, in case you're wondering who Hon Hai Precision is, and darker the green, the bigger the surprise they've had in earnings. So you might think, Apple too late. But what about some of these? Do you know who Hon Hai is? It's another name for Foxconn. You know who? And by the way, I interviewed the CEO of Foxconn yesterday, Foxconn Asia yesterday. If you followed my LinkedIn, you'll know that. Hon Hai is another name for Foxconn. Foxconn are the ones who see that iPhone that's made by Foxconn. Where's my Microsoft? Yeah, Microsoft also make for Foxconn also make for Microsoft, or Hon Hai do, and Hon Hai also make for Apple. Anyway, side issue, do we buy into them though? Maybe they're overvalued. Maybe, Alpesh, you're not the only one looking at this. Maybe we should click on Hon Hai and see who its suppliers are. Keep working down the supply chain until you find some crazy guy in Vietnam who's selling to them and along the chain. We'll work it out. We'll work out a clever, smart way of doing it. But what's our end goal? Let's start with our end goal and work backwards to our strategy and individual stocks that I own now, which are in my son's portfolio as well, so you understand why. Let's assume you've only got 10K to start with, whether it's Australian dollars, sterling, or US dollars, right? And you plan to add 6K a year, divided equally each month. Let's just assume that. Then your return looks like this. Oh, no, let me go backwards. I thought I moved the slides, but clearly I haven't. Let me go backwards. Assume you plan to invest over 10 years. Okay. And let's say with my help, you make 20% per annum. Some of that will just come from the market rising anyway. Some years you make more, some years you make less. Nothing extravagant, nothing pessimistic. Let's just say that's what happens. Okay. Those are the goals, and that's what you plan to make. All right. And so if that's the case, 20% per annum from what I've said. And if it's US stocks, I'd look at 40% realistically, and quality companies nevertheless. Let's say you got 100K, which is more than what most people have. It's more than what most people have. Okay. I know it's more than what most people have, but we'll go to smaller numbers in a second. All right. And basically over 10 years, you'd then have $1 million. That's the maths. And here's the graph. 20% per annum with the numbers that I mentioned, over 10 years, you'd have $1 million. My job is to convert every 100K into $1 million. Actually, it's to do it sooner than that, but I've gone conservative and said 20% per annum, right? 20K, but 20% per annum as a return. Let's say we go modest. Let's assume you only have 10,000 to start with and plan to add 6,000 a year, divided equally each month. Now, don't forget, whatever you've got today, some of you will have only £1,000 to invest with. Fine, get the education first. Make sure you're educated, you're prepared today for next year or 10 years from now when you are earning a lot more. Okay, I've got more capital or got an inheritance from a wealthy uncle or whatever else it might be. Okay, so let's assume you only have 10K to start with and plan to add 6K each month. Then your return looks like this with my help. That's what it looks like. But I'm going to ask 15 years in which to do it. Why? Because we only started with 10,000. So if you start with 10,000, you can convert it into $500,000 over 15 years. My job is to convert every 10,000 into $500,000 over 15 years, actually sooner, because I expect to do more than 20%. That's the graph for my son. My son's 2 years old right now, and he's well on his way. Actually, he's exceeding this returns at the moment, so that when he goes to university in 15 odd years, he'll have $500,000 in his account. Now you might say, well, why such small amounts? Why does he not have more? Well, my biggest problem will be to make sure he doesn't become a spoiled little brat, because I don't believe in inheritances. But we start him with 10. Why? Because that's the UK limit on tax-free ISAs. It's 9,000 a year, actually. We start him with a small amount of capital and keep adding to it. And that's it. That's where we're getting to. When he gets to university, I want him to have that. Or if you're going to retire, that. A lot of people come onto my investment program, these webinars, and say, actually, I want my children, my adult children, to do this. One's a dentist, one's a doctor. I want them to learn all this because they've got kids, right? Well, it's an important reason why we plan ahead, plan ahead, plan ahead, okay? And by the way, if you're wondering, is it possible? These are just my UK picks, largely UK picks. There's a couple of US, but on the whole, UK picks. And a Financial Times award-winning company has independently been verifying these, not just last year, right? Not just the year before, actually since 2004, in real time, they've been doing it. And you can see, and these are just with UK, 34%, 44%. Okay, so while I target 20%, actually, if I include US as well, I'm looking to get far more. And do I exceed it? Yeah, on the whole, right? This is how we get from 10K to $250,000. Just do it slowly, steadily, on the approach. So what's the approach? Well, this is what's in my son's junior ISA at the moment. He was born in 2018. Junior ISA tax-free. Maximum when he was born was 4,000. So he only had 4,000 in his first year. Right, reasonable sums, yeah? We're not talking about breaking anybody's bank. Right, well, what's the point of starting, Alpesh? Well, because the next year the government raised the amount to 9,000. Okay, anyway, Apple, he's up 66%, Globant 40%, Amazon 28%, Premier Oil, which was an oil strategy from earlier this year, he's up 24%. So all in all, he's about 48% up. Okay, well, that's that. He's actually up more than that because this is a bit dated. This is another ISA that I have, one of my ISAs. Okay, and this is largely this year. I think Amazon was slightly longer than this year, but the rest of this year since March, some actually just since the last month. Okay, that's what it is. Hang on, Alpesh, why haven't you sold best of the best? Why are you waiting for 12 months for that? What's this leverage? 2 times leverage, Apple, 80% up, and you only had that since March, as you told us in your March webinars and at Hammersmith when you gave your talk at the investor show there. There's many of you who were there. Let me know if you were there so I know. Okay. But cool, I'll answer that in a question, right? Now, there's many brokers you can set up your ISAs and SIPs with. In the UK, there's Hargreaves Lansdown, there's AJ Bell, there's Halifax, there's Barclays. There's a whole bunch. They're all safe players, you know, big names you've heard of. So they're all safe players. And there's a marginal difference between how much they charge. It costs about £12 to buy a stock, right? On the whole, okay, it costs about £12 to buy a stock, right? 3 times leverage, that's high risk. These are anything leverage is high risk. So put that to one side. Yeah, high risk, Alpesh, but you're up 51% since March alone. Zohair said it. He was there in March. Thank you, my friend. Okay, Square I bought last month. And I thought to myself, I'm getting in too late into some of these. Well, 31% late, who cares? PayPal, last month. Zoom, very late. I met the CEO in Silicon Valley last May. If you follow me on social media, you'll know that. I was out in Silicon Valley at a conference and he was there and I should have bought it then. So, yeah, do you know what? I don't have a crystal ball. I should have bought it then. But I'm okay with these. Right? So problem. Let's break this into 2 things, okay? Let's break these into 2. John, answer in the Q&A. Part 1. What's the problems with investing? And more importantly, part 2, what are the solutions? What are the stocks Goldman Sachs, Buffett, love? How do you find them? How do you put the process together? So quick problem. Let's do the problems first and then the solutions. Quick problems. First of all, this is how people buy stocks. They hear about a name, they hoard it. It's got no sense to it. Most of it's rubbish, okay, and they don't need any of it. That's how they buy stocks, okay? Secondly, they don't know when to let go, so they just bloody hold it. They had a really good run with Barclays 20 years ago, so they keep hold it in their portfolio. And they go, Alpesh. And I ask them, when I x-ray their portfolios for them, I do one-to-ones with them, and I say, well, why have you got that one? They go, I don't know. I don't know how to get rid of it. I don't know when to get rid of it. I was really good 10 years ago. These are all excuses they make. If you made any of these excuses, put your hand up. Oh, I hadn't looked at it. Oh, it was really good once. I didn't know what to buy in its place. Well, I don't know when to get rid of it. Like, how long should I hold on? Oh, but it might rebound. It's fallen off recently because of coronavirus. Maybe it'll bounce up again. All excuses used by everybody most recently. Like I said, if the markets go up, like I told you, as quality stock, well, I plan to hold it anyway, or I might even buy more. Performance stock, just wait for your time target. If it falls, quality stock, I'll buy more. Performance stock, no, you wait. You never add to a loser. I make my life very simple. So forget that chart for a second. The other problem people have is they try to pick winners. I'm not trying to pick the best stock this year. I won't do it. It's like throwing darts at a dartboard. All right, I'm trying to pick the best winning portfolio, the best team. So some of my stocks, even though I use the same criteria to select all of them, some of them, like an Innovia, will go up 100%. Others have still hardly moved, and they're at 0%. Merck, right? I bought Innovia and Merck at roughly the same time, give or take a couple of weeks, on the same criteria. Merck's still at about 1% return so far, and Innovia is at 100%. Hang on, Alpesh, you looked at the same criteria. How the hell did that happen? Are you spending too much time smelling the roses and playing with your son? Probably. But what it is overall as a team, I'll hit my 40% per annum. Oh, Alpesh, you know what? Now you should try and work out why you... No, I'm fine. I'm happy. I still hit my targets, okay? I'm not greedy. I want to make the money I make, and then I want to spend time with my kid. I'm not greedy and trying to chase the market and find every nuance, right? The other problem... Rubbish fund managers. This is the biggest bloody problem. You can be better than overpaid fund managers. The only person in the world who has a right to say that is one who, as a private investor, beat overpaid fund managers and has kept on doing it. The Financial Times said, you got a big mouth, Alpesh. Why don't we run a competition, make it public, see if you can beat overpaid fund managers like Neil Woodford? And I said, all right then. So we did it. And I beat him. And I came top. And I said to the FT, on one condition, when I do beat him, you put it on the front page of your bloody paper and say, Patel is top FTSE 100 forecaster. Deal's a deal. They did it. Over 12 months, we did it. I beat people like him. There you go. He narrowly beat the bloody editor's cat because they thought, the FT thought they could embarrass me by having a cat in there. Nah. Sorry, guys. The other problem with fund managers is this. Look at that. That's a typical UK listed equity growth fund. Sounds really good, doesn't it? Equity listed, equity growth. A fund manager is going to look after things. They're really clever people. No, I went to university with them. Trust me, they're not clever people. All right. I did an experiment. I converted my secretary. She left University College London. I converted my secretary into a fund manager. She now manages 10 billion for Newton. I did the trick that they have in trading places. I'll show you. I'll introduce you to her in a second. I'm proud of it. I am an enabler, an empowerer, an educator of people to make them into multimillionaires. Okay, social mobility, blah blah blah. But my point is, and you can call it Newton if you wish. My point is this: I can turn people into it, but not these muppets. Who's this? UK listed equity growth fund down 3%. The stocks we're looking at aren't down 3%. No, down 2.3%. 2.3. That's your average. People go, oh, he's got a fund manager. Yeah, he's got lots of diamonds. Look, diamonds. Oh, he's got an 8 out of 10. Oh, he's got booster in the title. He's got vitality. Vitality is a joke. It's a marketing machine. Okay. And these are the top 10 holdings of that fund. No wonder it's down 3%. They went into oil before the oil price crash. They went into British American tobacco thinking that's UK equity growth. Oh, really? Have you looked around recently? More people smoking, are they? Flipping heck. Muppets, get away with it. These are their top 10 holdings. Almost 10% in bloody oil before the crash. Yeah, that's what your pension's going into. Can you afford to retire? No. No, you cannot. Do you know who can afford to retire? That fund manager. You know why? Because literally, this is from their document. Every 5 years, if you cash in after 5 years, recommended holding period, I bet it's a bloody recommended holding period because he's guaranteed to rip you off £1,000 every 5 years. Every 5 years, they're going to take £1,000 off you. Out of your 10,000, 10% goes to the fund manager. Nice little business, isn't it? Yeah, you can hate us fund managers all you want. I used to be a lawyer. I'm used to being hated. My next job's going to be as a vampire. Okay. Yeah. £10,000, they charge you £1,000, and they tell you in the small print. So I asked one of my students, I said, have you seen this? Because I pull out these documents for them and show them. I do a one-to-one with him and showed him the documents. He goes, shit, I hadn't seen it. I said, do you know it's there? He goes, I hadn't seen it. I just assumed, And I said, did you know he'd put money into these? He goes, oh my God, if I knew that, I wouldn't have bought it. I said, yeah, you bought it because it said UK growth. You thought he's putting it into some clever little AI company, some clever little tech company, didn't you? He goes, yeah. I said, if you knew he'd put it into bloody, Unily, Experian. Geez, great, thanks, Diageo. Okay, problem 2, where to look. Most of you don't know where to look, so this is what you're like, okay? Problem 3, when you find where to look, you don't know what to look for. Look at all this bloody information. Do we look at the consensus, the target price, the analyst forecast, the directors buying? By the way, journalists, I tell you how stupid journalists are, financial journalists have, the financial journalists would write an article. Have you ever read one where he goes, oh, directors have bought into the company. We think that's a positive sign. You know why directors buy into stocks? When they think it's up shit creek. You know why? Because they know journalists are going to write, our directors are bought into it. They're showing confidence in the company. No, they're not. They're signaling it's in trouble, knowing a journalist will write that our directors bought into it, so it'll boost the share price. So they'll buy £10,000 worth before dumping the 100,000 they already held after the price goes up. Think about it. Okay, basic game theory. But a journalist isn't clever enough to work that little baby out. Okay. Don't trust me, trust the logic. Okay, quality. I've written about it in the Financial Times, but if only people would listen to you, Alpesh. Okay, so what do they end up in? They end up in Lloyd's. Lloyd's, I asked my students, how many of you got Lloyd's stocks? Lloyd's stocks. Okay, well, it underperformed the market in 2016, 2017, 2018, 2019. I'll come good one day. Alpesh, gonna come good. Got name recognition. Got name recognition. My job is to stop you making stupid ass mistakes with your money. It's not my money. Not my money. It's your money. With your children's inheritance, with your retirement. Okay. Expensive courses and subscriptions. It's my job to have the expensive courses and subscriptions. It's not yours. Okay. My job to teach you. All right, on all of this. It's my job to be up to date with everything that's happening in the global market and then say to you, all right, guys, this is what's happening. This is where we are. This is what we're seeing. Let's see where we think things are moving, where you should be looking at, and what insights we've got from who owns what, where, and when. All right. It's my job to be doing all of that. Not necessarily yours, but mine. And to know who's looking at what, where, and what might give an edge, what won't give an edge, what works, what doesn't. Okay. And that's a big problem, private investor. They keep trying to look for the Holy Grail, paying more and more money and trying to get to that. They're also a big problem of trust. And by trust, I don't mean commentators. Screw the commentators. None of them are around you get anywhere. Otherwise, they'd be managing funds, right? This is Wall Street's 2020 outlook. According to Barclays, Citigroup, Deutsche Bank, Goldman Sachs, JP Morgan, Morgan Stanley. Just look at that. Deutsche Bank, Morgan Stanley. I just want you to focus on those for a second. Let's just focus on these. Deutsche Bank, Goldman Sachs, JP Morgan, and Morgan Stanley. You'd think pretty good, wouldn't you? Well, JP Morgan says 3,400 for the S&P. Morgan Stanley says 2,700. And then Deutsche Bank come in a bit closer to JP Morgan, and Goldman Sachs come in a bit middle of the road. Whoa, who the hell do you trust? All right. Citigroup has said 2,700. But JP Morgan have said 3,400. And by the way, that's just these guys. Binky. Shit, I think I know Binky. Binky has said 3,250. Deutsche. Luckily for Binky, there's about 15 other people at Deutsche who've said different numbers, every single bloody number you can think of. So Deutsche Bank at the end of the year will say, yeah, one of our guys got it right. Yeah, throw enough darts. Somebody's going to get it right. Okay, rich, poor divide. There's a divide in information. Let me give you the information. Let me tell you what's involved. That's one of my columns all the way from 2004. Forget such magazine headlines as 10 stocks you must buy now. Market success has nothing to do with the stocks you pick. What? What does it have to do with? It has to do with the data behind the stocks. So let me tell you that. And I've been telling people this. I've got form, I've got experience, okay? Also, there's a rich-poor divide because it's my job to get access to Goldman Sachs's reports, not because they might be more accurate, because they give me names to put in the top of the funnel for me to filter, because after all, they might be self-fulfilling prophecies. Now, you can call up Peter if you want. There's his phone number and there's his email address, okay? Or Sharon, or Guillaume, or Lilia. All of them you want. There's investing in 2020 and beyond. 7 themes, 3 stocks. My job is not because I buy everything they say, but it's because I put it into the top of the funnel to then determine, is it worth following? Okay. Equally for UBS and their conviction list, their best and brightest ideas. It's my job to then share all of that with you guys. Okay. To be that insider mentor. So I know, what are they telling? What are they spewing out there? What are they saying to people? Right? And what are they saying about things like coronavirus as well? Okay. And distilling it and putting the names into the funnel. So how are we going to now filter the funnel? That's what I want to discuss in the final part of this webinar. The most important part. How do we filter? We've got all these names. Now we know what the problems are. Let's get to the solutions. Okay, let me tell you what the solutions are to these. The way I look at it is your holdings are dependent on a number of strategies for generating names. These are not strategies for anything other than generating names, and then we filter. So what are these strategies? I'm going to give you some of the ones I use. Feel free to copy them. You might have your own, but feel free to copy mine. First thing I look at to generate names, not because this is my starting point. For most people, the biggest mistake they make, this is their end point. Just because a guru buys it doesn't mean you buy it. That's the end point. That's wrong. It's a starting point to look at the names. And if you want to know whether or not I'm blowing hot air, well, that's me back in 1999. All right, 9/11, 1999. Right. What's more, you should probably sell up your entire UK holdings and buy US stocks. Why did I get that idea? What the hell? You unpatriotic son? No, it's very patriotic of me. As a Brit, I own and I have people in America working for me, paying me returns from their companies. These technology guys work for me, basically, because I'm a shareholder. That's what they do. They're managing my son's inheritance. The people at Microsoft manage my son's inheritance, okay? Or Amazon, or AbbVie, or Eli Lilly. I'll tell you what the other ones as well. And not just American companies. There's other countries as well. So I'm not just blowing hot air. There's 21 years of bloody proof of it and published. Okay, so where does that take us then? Where does that take us? Well, I'll tell you where it takes us. It takes us here. I will generate name ideas, but I won't just follow them just because Warren Buffett. It's the point of my team. It's their job to tell me, what the hell does this bugger own? Okay, what's he increasing his stakes in, and what's he getting rid of? But that's not the end point. Most of you will go, oh, quick, shit, what's M? What's C? Citibank. Okay, I better buy it because he's bought it. Wait a minute, how do you know for how long to hold it? How do you know where to put stop loss? How do you know whether it's still worth buying? How do you know he hasn't just bought a tiny bit to screw you over the same way the other people do? Or what Schroeder's are saying, okay? And when I tell people and share some of this with them about Amazon, Microsoft, Apple, Alphabet, and Facebook, no, Alpesh, we heard that name 20 years ago when you mentioned it then. We still think they were rubbish then. Fine. Okay. Solution. Ride the coattails of the aggregate of the world's best. So one of the things we look at to name generation in the guru strategy one gurus, is what are the hedge funds buying more into? What are, based on the activity of not one, 21 hedge funds in the recent quarter. It's the job of my team to tell me this. They've got to put this data in front of my nose. And I go, right, okay. And then I'll analyze AbbVie some more. It goes in the top of my funnel and I bought into it. Thank you very much. Done okay. Or Stanley Druckenmiller, the George Soros' business partner. What does he own? Okay, what does he own? What did he buy? What did he buy? That just puts the names at the top of the funnel. I do happen to own Adobe, Alphabet, Amazon, as I've told you, Facebook I happen to own, Netflix my son owns. Okay, PayPal I own. All right, why not the others? Why didn't you pick? Well, I'll tell you in a second why not. Why some and why not others? Because they have to go into our funnel. Whatever the names of the stocks are, they have to be part of one of the 7 strategies. Then we use the software to work out or tools online to work out how do we decide which ones are good enough, which 15 make our list, and why only 15? And I'll tell you. Okay, why 15? Strategy 2, I leverage big on low risk. What's low risk? Well, my quality stocks, Amazon, Alphabet, are low risk. What do I do? I leverage big. Why do I leverage big? Well, I buy 2 times leverage Amazon. Now, before you get carried away and think, oh, let me do that, that does not mean if Amazon does this, okay, and doubles, your money will double. Leverage doesn't work like that. It's high risk. Warning, leverage is high risk, okay? So, but it's all very well you saying that, Alpesh. So this was Amazon over a year, and this is Amazon over 3 months for me. What? In 3 months, you got as much as you got in a year? Yeah, that's what I did. But that's high risk for me. Why? Because I leverage big on low risk. What's low risk? I think Apple and Amazon were low risk. So I got my returns. Why didn't you just put all your money in there? Sell your mother-in-law. eBay your body, Alpesh. Would have raised at least a tenner on that and then put it in. Okay? Can you all please stop obsessing over bloody Tesla? This is the problem. Something jumps up a little bit. Does it make the mark? I'll tell you in a second. God, this is why. Do you know Tesla has the biggest number of stock shorts in world history? Did you know that? $20 billion worth of shorts on Tesla. I don't want to gamble on Tesla. I don't want to gamble it's going to rise. I don't want to gamble on the tweeting habits of Elon bloody Musk. And I don't want to gamble on the fact that $20 billion are shorting Tesla right now. I don't want to gamble because it's my son's inheritance. If you want to gamble with your children's inheritance on Tesla, please be my guest. But I will give you the hardcore fundamentals. Want to gamble? There's Ladbrokes. There's a casino. I don't want to. We're here for more serious reasons. So investing strategy 4B. What do banks tell their clients? I want to know what they're telling their clients. I want to know, are they bigging up companies? Are they bigging up companies? I'm not trying to pick the biggest mover. I'm trying to get my modest 40% per annum. So if it means I don't gamble on a Tesla shooting up or shooting down, so be it. So be it. That's it. Okay. I'll talk brokers, and all the brokers I mentioned, John, already do. Right? But I want to know not just, and this is the next level stuff. This just puts names at the top of the funnel. I don't want to know what RBC or Merrill Lynch are saying, but I need to know, are there a lot of others? When did they say it? And does Brett Huff or whatever at Barclays, does Ramsey have a good track record of calling the market right in this particular stock? That's the level of detail, not just Barclays have got a buy rating. couldn't care less. When did it come out? Who else has got it? And has the person from Barclays got a good track record in this particular equity? If not enough data, then don't care. What does a journalist write? Barclays upgraded. Who gives a shit? What actually matters is all the information under that iceberg. Otherwise, you're going to have a crash. You know what I think is one of the most important things? This from Goldman Sachs. Now, I got this about 10 years ago from them. All right. This is what they tell their wealthiest clients. Goldman Sachs Asset Management, okay, tell their wealthiest clients, and this is how they pick stocks for them. They use something called the Croaky. This is not the only thing we look at. It's one of the things we use to filter. Okay, is the Croaky. And this is why Tesla's not on my radar. And I don't care that it's not. Because if I wanted to gamble, I'd go for the Kempton Park 330, right? Debt-adjusted cash flow. Debt-adjusted, so it's about cash flow. It's about cash flow and the ability to generate it. What Goldman Sachs worked out is if your company is particularly good, it's in the top 25% of all companies at generating cash flow, then on average, over the long term, it'll give you a 30% per annum return. 30% per annum. Do you like that? And guess what? It'll be rubber stamped by Goldman Sachs, who will make it a self-fulfilling prophecy. Why did Goldman Sachs give me information like this? Are they trying to fool me? Well, they want not just their own trillions, not just their wealthy clients' money. They want my money in my hedge fund also to follow what they're saying. So it leverages and creates more return. That's the slide from there. Anyway, I've been using Croaky ever since those last 10 years. This is what I mean when I say there's a rich-poor divide. So which companies do I like at the moment which have good Croakies? Okay, and the other factors, not just this factor, it's got to be others. And how do I do it? Like I said, I don't just want undervalued companies. I don't just want income generating companies or just growth companies. That's a bullshit approach. Big funds do that. They'll say, oh, UK growth, UK income, UK value. Why? Because they want to sell you 3 different things. Why are they limiting it to one style, which may or may not work at different times, and one geography, which may or may not succeed at any one time? Why are they not interviewing all 8,000 companies? Because if they did that, they'd only have one fund and one thing to sell you. That's why they don't do it. And that's why they want to make it sound complicated. So you don't do it and you go and give it to fund managers instead. Right. And if you don't think the city is that dirty, you're naive. Right. So we want this bit. We want this bit. We want that bit. So which ones for me? Well, I interviewed the 8,000 companies. I data analyzed them. I'll show you which ones at the moment meet that criteria. And I would say you pick 14 to 15. What research, Alpesh? Everything I do is backed by research. It's been published in the Financial Times. It's been published in my books. It's been broadcast by me in my lectures at Oxford University, where I'm a visiting fellow. All right. It's 14 to 15. I'll tell you how many in a second. Equally, in equal sums with 25% stop loss and a 12-month holding period. That keeps it simple. Now, you can complicate that if you wish. You can say, well, I'll review it each month, or what if they then fall this much? I'll do that. You can review. I'm going to give you the simplest variation, and all the other variations you can discuss later, but let's keep the simplest one first. And that's enough to give us our returns. Everything beyond that takes time away from me smelling the roses and playing with my son, right? This is part of my database. So we then put it into a database. What's low value, growth, income, momentum, Croaky. I also want, I'll explain Sortino and Alpha, which is something particularly used by hedge funds, not by long-only fund managers. They wouldn't even know what that is, okay? And I'll give you some of these names. The reason I blurred it out is because this webinar, someone's going to look at it a month from now or 6 years from now and go, and have a heart attack, okay? So I'll give you an example. I want to see not just that hard data, but I want to see what are the analysts saying. Okay, so they reckon 121% upside, but that's not enough for me. That goes into my filter of names, and then I look. Does Tesla have a valuation, growth, income, momentum, Sortino, Alpha, which would put it in here? No, it doesn't. What does that mean? It doesn't mean it can't double in another year. What it means is I'd be gambling. I'd be taking greater risk. Right? Just because you walk across the road with a blindfold doesn't mean you won't get across the road. It just means if you do get across the road, you were lucky that you didn't get run over. I don't want to be lucky. I want to reduce luck. But Alpesh, it means you missed it. I am not trying to get every single stock that rises. I'm trying to get 15, which will get me my 40% and make me the millions. I'm not trying to get every single stock. Okay? I'm not trying to get the biggest movers. Got it? When you try and get every single stock or the biggest movers, you're going to lose money, and you might as well go to Ladbrokes and you're gambling. Okay. Cash return on capital invested. That's what Croaky stands for, John. Cash return on capital invested. Okay. And it's only one factor. It's not the only one, because the other factors include, so we don't just look at that. We've got to look at other things. Hedge fund ownership. Okay, and I'll show you how you can do all of this in a second. Just give me 10 more minutes. All right, and we look at this. What are the hedge funds owning? Which are the biggest names they own? And then we'll cross-refer that. Why? Not because they did it, we did it, but it goes into the funnel, goes into the funnel, goes into the funnel. So Globant's something I own. Argentinian IT company. Are you crazy? No, it's listed on the New York Stock Exchange as an American depository receipt. I've been saying for 20 years on my FT columns, buy American depository receipts. Okay, there's a reason the BBC continue having me on for 20 bloody years. Okay, and the reason for it is, especially when there's market turmoil, well, I put my neck on the block. I'm not being arrogant. Okay, I'm not being arrogant. And what I'm trying to tell you is my frustration that private investors keep getting it wrong because there's too much crap and noise out there, as I've been saying for 20 odd bloody years as well. And I'll say it as clearly as I've just told you guys, because I say it on air and I have no embarrassment about saying it, right? As well. Globant. It's one that I've got. Does that mean it's going to shoot up? No, it doesn't. It just means valuation. So if somebody said to me, why did you pick that, Alpesh? I'll say valuation, growth, income, momentum, performance, volatility, hedge fund ownership, news flow. Well, that's a lot of things to look at, Alpesh. No, it's not. I'll show you how we simplify it. And why did you say 15 stocks? Well, this figure. Risk on the y-axis, number of stocks there. In fact, you could make that, if you wished, as low as 10 stocks if you're more risk-loving. And if you're really risk-averse, 40 stocks. Okay? Just depends where you are on that profile. Risk-loving or risk-averse. Simple, simple, simple. So another strategy that we use, I won't go through all 7, but another one. What does sovereign wealth funds, in other words, the biggest money in the world, and family offices look for? Family offices are offices of the super rich. It's my business to know them because that's what hedge funds do. What do they look for? They look for 2 particular factors. When they're asking us, okay, we've got sovereign wealth funds which have invested. We've got Aegon and AXA which invested in us, and we've got the Hungarian sovereign wealth fund, would you believe, of all things. We'll take the money wherever it comes from. Okay, invested in us. Now, what do they ask for? They ask for Sortinos and alphas. What the hell are Sortinos and what are alphas? I'll tell you. The Sortino is a measure of performance and consistency of that performance. There's no point somebody saying, this stock is up 10% per annum over the last 5 years. If in year 1 it was up 100%, but for the last 4 years, it's been down 10% every single year. Well, it still have an average of up 10% per annum. But actually, chances of you getting that are very low, obviously. Well, that's what Sortino measures, and the alpha measures outperformance of the broader market. Because we want not just consistency, i.e. lower risk, lower volatility of performance, but we want to make sure outperformance in the market. So why would we not apply that to an individual stock? Ideally, I want a Sortino above 1, but above a half it will do, for reasons I won't go into at the moment. And alpha I want to be as high as possible. And I want that croaky to be high. And I want the value growth income. Alpesh, you want the moon on a stick. Yes. Did I not mention this is my son's inheritance? I'm trying to put it in a phraseology you'll give a damn about. Well, you won't give a damn about my son. But how about your children's inheritance? How about your retirement? Now you start to care. Now you start to think, shit, reading Investors Chronicle and a journalist headline really might not have been safe enough, due diligence enough, given my future depended upon it. My retirement depended upon it. Shit. Better not tell my wife or husband that I've been gambling with our SIP. Yeah? Okay. So, why Holy Grail? That's my Holy Grail. That's what my Holy Bloody Grail looks like. Okay? It looks like this. Okay? Not only am I looking at value growth income, croaky, price momentum, Sortinos, alphas, Altman, I've not gone into in this. Piotrowski, I've not gone into in this as well. Return deviations, volatilities, correlations, blah, 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 blah. Then we get a short list, okay? And I hold them, and they've got to perform. They've got to perform. They've got to be the best of the best. I'm picking the Liverpool Football Club of teams, or the Leeds United, or Manchester United. Do you know what I mean? I'm picking a team. They've got to be the best. If I have to spend more, and here's a rule for you all. If I have to spend more than 5 minutes worrying about a stock, it doesn't get in. If I have to spend more than 5 minutes, forget it. It should be a no bloody brainer. Yeah, but Alpesh, you missed Tesla. Seriously. Okay. Scan fast, US, UK, global ETS, monitoring frequently, one screen, not one strategy, different ways of getting names in there. 20, I say 20 maximum. If you're risk averse, you can even go to 40, but you know, diversify, make sure they're not correlated. Stop loss 25%. I'm going to give you the tools in a second as well, and which ones I own as well. I add to quality companies if the market goes up, and I wait for performance ones. If the market goes down, performance I wait, or they hit the stop loss. Quality I buy more of. I don't do it in between 9 and 5. Why? Well, because the market's alive and I'll get all carried away and excited. Okay, 1 hour max to find 10 investments in a short list. Okay, you know why private investors get it wrong? Private investors get it wrong because they don't know what to look at. They don't have a strategy. They add to poor quality losers. They panic on profits and take them too quick. They panic on losses and add to their losing trades. They have expensive subscriptions. They rely on journalists and brokers, okay? And they spend hours and are confused. It's as simple as that. I developed all of this when I was at university. That's when I met people like Bill Lipschutz, who worked for Warren Buffett. Okay, perfected the strategy. I won competitions, as you can see. The FT then said, would you like to write books on this? I said, yeah, I would. As you can tell, I'm a big mouth, so I do like to get the message known out there. So then people said, well, tell us what do you own? Why do you own it? Show us all of this. And initially, we created for our own internal team the self-paced education. I've given you some of the stocks that I own, okay, like Square and the others that I showed you. Okay, and I'll go through those again and what's in my son's ISA as well. But people said, well, we want to go beyond that. What about after a year? What about right now? What about updating it? What about looking at our existing portfolio and evaluating that based on criteria and all this hard work? Can we do that? Can we speak to you? And I said, no, I ain't got time to do all of that. Then we thought, wait a minute, why don't we spin out an ed tech company, educational technology, out of the hedge fund? And that's what we started doing, because people said, we don't want travel. We don't want somebody connected to a broker. We want that Goldman Sachs information. We want ongoing support for life. We don't want subscriptions. We don't want to pay anything every day, every week, every month. We want daily updates. We want alerts, want newsletter from you, Alpesh, newsletter and ideas on what you're doing, and for sake of transparency. We want software, but without subscription. They said, we want all of this. And at first we thought, no. And then we thought, wait a minute, we've got $1 billion business here. If we get venture capital investing, prove that this can be done, and float on the stock market, because that's what the world wants. They want all of this. They want to know how to do it, and they want to be able to do it. And they get proof in the pudding because they see their portfolio. Okay, so we started doing it. Thank you. Okay, Els, I'll speak to you about that in a second. It's updated monthly, the spreadsheet in itself, because the stocks don't need to be updated every day because the companies don't produce accounts every day. Hedge fund manager, professionally trained communicator. I'm a barrister and trained by Bloomberg, where I had my own TV show. The only 2 names in finance you should trust are Bloomberg and Financial Times, both of whom paid me. Bloomberg paid me for my TV show, Financial Times for my column. Visiting fellow at Oxford University, so the research continues into all of this, because of course now we've got algorithms, you've got all sorts of other things that you've got to look at, okay, and awards in the Financial Times, as you well know, okay. That's it. Everybody else out there was a joker. So we thought we really need to get this out there, not least because we had a brand and credibility and track record. And we thought we need to create $1 billion business. And we had endorsements from people like, we as in me, had endorsements from people like Bernard Opity, chairman of St. George's, that's $2 billion hedge fund. Okay. MD of Merrill Lynch, CEO of American Express Share People, chairman of the world's largest exchange. Okay. BBC, right? Seasoned traders, investors, alike will learn much from Alpesh's no-nonsense guide to the industry. You know, this kind of thought. And then we thought technology's come along so people can communicate with me one-to-one on WhatsApp, on Telegram, which is like WhatsApp, where I can tell you, I can give you the latest information and data as we see it, what we see, make sure you get it, and we tell you what's important, what isn't, and why. Okay, it's our job to track the virus spread and how it's affecting any particular company, stay one step ahead of the markets as a result of all of this. What does that mean? And if you better believe hedge funds are tracking the virus spread, okay, and working out, okay, whether Gilead is worth buying or not, right? Is it or isn't it? Okay, that's our job. And then we thought, well, if this technology exists, this company now is something we should have, where we create it. And give people that one-to-one tutorials, just like I had at university. So give them course material, videos, all that updated every day. But on top of that, don't just give them a course. That's why I called it a program. Give them one-to-one tuitions, as I had at university. Make them to be absolute gurus. And that's what we do. We created this educational technology company, which gives the software, the courses, the program, the materials, which I'll show you in a second, all of that stuff that it gives. And the idea was, by giving all of that and the one-to-one tutorials, you were able to prove to the market that this is going to be a $1 billion company and get venture capital investment into it. And that's where we've got to. My aim is to get 200 people onto this program. Okay, 200 onto the program in batches of 10. Why do I limit it to 10 at a time? I limit it to 10 at a time for the very simple reason that I'm doing the mentoring. I'm the one going through their portfolio and one-to-one tutorials, taking them through the program and so on, and the course materials. And we called it the Great Investments Program because that's our aim, to have great investments. We thought, what should we price this at? Given that there's lots of software, there's no subscriptions, there's mentoring from me one-to-one, there's a course, there's tips, there's one-to-one tutorials, lifetime updates, daily updates actually for life. Well, we thought maybe lifetime updates are worth 10,000. Maybe added value to the portfolio is worth 50K in somebody's portfolio over a period of time. Even if today they've only got £1,000 or 10,000, maybe in 5 years, because it's for life, over their lifetime, they'll earn that much. Maybe access to these reports that we have, maybe data subscription, but at no cost to them. So they're saving maybe $5,000 just there over a lifetime. Daily updates and tips from me, I don't know, 10K, free software source for everyone. 2K monthly tips newsletter, as well lifetime to regulated fund manager, WhatsApp, phone access. Maybe that comes to £90,000. Don't worry, we're not going to charge £90,000. Thought, well, we can't charge that. What we've got to do is spin the company out, put it on the stock market, let the stock market pay for it, and allow us, therefore, to give it at a lower cost. Okay, and that's what we did. And by the way, my most successful person is this one, Naomi. She used to be my secretary. She left university, became my secretary. I trained her up on how to invest. She then left me, joined Newton. She now manages 10 billion. Simple as that. Simple as that. Okay? You'd expect me, if I'm, everything I've said, you expect me to point to somebody bloody successful. Well, she's the most successful person we've had to date. 10 billion. If somebody else beats that, I'll let you know. Okay, left university, joined me as my secretary. She was at University College London, joined me as my secretary. And then 3 years later, after training from me, moved to Newton, and she runs that. So I want 10 people, batches of 10 at a time. Thank you very much, Els. Els has said, Els is one of our people. I'm going to broadcast that, Els. That's a wonderful, wonderful comment you've made. You're in Holland, aren't you, at the moment? So this is it. I want people to have access to the software instantly, the mentoring, the course, the tips. I'll show you all of that. That's where you go. I want you to sign up. We want to get to 200 people through the program in batches of 10. Okay, and then I want to get the venture capital investment in, the valuation about several million anyway, and then float it in a few years. I want everybody who's on it to have free shares in it as well. That's my aim. 7-day no risk money back guarantee. And you know what I do in those 7 days? Not only will you get signed copies of my book, not only that, but you'll have a one-to-one. I'll already have gone through your portfolio with you and had that first call with you to go through it, analyze it, give you full access to everything. So in 7 days, you will stay on board because you'll love it. You'll love it. You'll get access to my portfolio, the webinars that I do, the Telegram channel that I have. So it's like WhatsApp, and you'll see my posts on there, everything that we get, the insights. So you're an insider now with me, and you'll have that call within the first 7-day money back period time with me, the portfolio analyzed and uploaded online, access to all the material, access to my spreadsheet as well, and all of this, and access to me, and that starts straight away. So you get all the softwares, everything straight away, and you'll learn that within 7 days. We've never had somebody turn around after 7 days and say, oh, it's not for me. It's as simple as that. And if you go to alpeshpatel.com/shares2, you can do installments if you wish. I want to spread the word. It's the people who essentially pay for me to do these free webinars. Okay, and it's pretty phenomenal. I think it's never mind. I think it is the best investment education in the world. It is the best investment education in the world. On whichever measure you use of best, it is the best investment education in the world. We have some people who pay in installments because they say, you know what, I'll do the first installment and then I'll see how it goes for me and use future to pay the other installments. And it's entirely up to you, okay, how you do it. And you can see all the stuff that's in there, the JP Morgan, the Goldman Sachs reports, all of this on the updates and what the banks are telling their wealthiest clients. But more importantly, some people don't want to do the education. They say, screw that, Alpesh. What I want to do is give me the stocks, give me the names. And I go through their portfolio. We work out what should be bought, hold, sold, and then we work into educate them to work out what they might want to hold in the future. If you want to do installments, it's there, and the 50% off comes off. The 50% is only for the webinar, Okay, it comes off there. So this link will not work after the webinar, and then you're paying even less to start now. It is normally 20,000. You can do it in installments, and 50% off is for the webinar. Why? Because people who've stayed to the end of the webinar, I think, deserve better than people who just don't bother. All right, people who don't bother. Okay, because you guys don't want shortcuts. You can. Oh, by the way, if anybody can't get on, Timothy, I will email you now. There's a few of you who can't get on. It just happens if the website. Let me just message you now and get you on. I will send you across and hold a place for you. I'll send you a link whereby you can pay, or you can do the transfer. Sorry, Joseph, Timothy. The reason is sometimes the IT stuff. It's just if too many people are on the payment page, it thinks there's a denial. So that's why we have two pages: shares 1 and shares 2. alpeshpatel.com/shares1 or shares 2. The coupon code should be embedded in there already, and it should say 50% off. Okay, but it's on there. We've been going great guns with this. Everybody that we've had has given us such amazing feedback, which is why the price keeps on rising, and it will continue rising, because we want to show the venture capital investors into this, how good all of this is as well. And that's the reason why. So yeah, if you go to alpeshpatel.com/shares1, you will see the 50% off. If you don't, just click on add coupon. If you go to shares 2, it should also be embedded, and that's where you can do the installment, PayPal as well, Visa, American Express, all fine. That is our goal. And the feedback is phenomenal, like I said, from the period we've been doing it as well. And we think there's I'll tell you the demographic breakdown. I would say there's a bunch of people who are doing it for their SIP in their 40s, 50s, 60s. There's a bunch in their 70s who are doing it for their children. There's some who buy it for their adult kids, wanting them to do it. And then the adult kids say, well, I want to do it also for my children and learn. Okay. Somebody said my broadcast has frozen. Let me turn off the video. That might help if it's frozen. Okay. That might be the reason if it's frozen. Okay. And yeah, we've had some great people like CEO of TD as well endorsing the work that I do. And the idea is within the first 7 days, what I want to happen is we have that first call. You've already sent me your portfolio. We've uploaded it, analyzed it, given you access to all our materials, but also then worked out how we get from what's in your portfolio based on the education we'll teach us. It's practical to what we own, what we like out of those 8,000. Okay. And you can see and learn objectively. So if somebody says to you, Alpesh, I like Adobe, you'll be able to say, well, actually, on a valuation basis, growth, income, momentum, and the other factors, Sortino, Alpha, Croaky, yes, you're right. But we think this other stock's better because on the same criteria, it ranks higher. So at least you'll basically be able to be a fund manager like Naomi was. And we just shortened. We took the training that we're giving her and others in my firm and just put it out there. Okay, we took that training and we put it out there. So if anybody can't sign up and wants me to hold a place, let me know. Any questions? Let me know. Hopefully all of that's made sense. You saw my portfolio, you saw what I hold, you saw why we hold it, you saw what we do, why we do it. Okay, all of those things you've now seen within that. And that should give you an insight like nobody has ever had into not only what we do as a hedge fund, but also what hedge funds tend to do. Okay, and that's important. It's important that you understand what it is we do. And what our goal is and how we want to get more people educated, more people learning. And we'll do the complicated stuff so you don't have to. We're not just going to dump you with this is Apple, by the way, and its equity percentage moves in recent months, well, over the last 2 years, and where it ends up on any given day. Well, that's complicated. So we don't need you to learn this. We'll give you the output and say, well, this is where it ranks highly on this. That's what gave us the insight. And you, if you wanted to learn it in more detail, can. Some people say, no, just do the working out for me. A bit like a maths lesson. Do the working out for me. Others say, no, I need to know everything. I need to know it all in terms of every single aspect of of a company. Okay, it's expected market return. I want to know its equity relative valuation, or actually weighted average cost of capital. It can be a really clever way of knowing whether a company's getting into trouble, and whether it's paying too much for cash, and how much is going to show up in its share price movements going forward. People don't know that. They don't know the stuff hedge funds look at. Okay, what they know instead are the kinds of things that they're taught by journalists, and that's not good enough. It's not good enough. Okay. Thank you very much, Els. No worries. Do send me the email. My pleasure. Okay, everyone, I'm going to go. Thank you all for everybody who signed up. I want to thank Joseph. Yours went through as well. Marcus, it went through. Rickin, it went through as well. As did Rowley's as well. I can see that. And Ashwin, yours has gone through as well. Thank you all very much. If for any reason it's stuck and it can't go through, let me know. So I hold a place for you, because places are limited. Returns aren't, but places are limited. Okay. Whilst nothing is ever guaranteed in the markets, one thing is guaranteed for sure. Education is the secret bullet, and that's what we provide. We provide the best investment education in the world, and practical, okay? Practical education as well. I'm not showing you what I'm seeing. It's worth some of the stuff that we're looking at is quite interesting. I'll post this for the people who are on board. You'll be given access to my private Telegram channel. You'll get some of this posted on there today with my evaluation and analysis of it, so that you can see what we think is actually moving, and why, and where we think it's going, and where we think the markets are taking things. One of the things that we love is the intelligence that we get from hedge funds. Okay, and that, I think, gives us an edge, because that means we're running on the back of the capital that's investing from a whole bunch of the biggest researchers. They spend millions on it, and we track on the back of it. Okay, so we get hold of some of that research that gives us names, and then we narrow down on those names, and we work out, okay, if that's the case, what should we be investing in, and why? Okay. Brokers. So I use Hargreaves Lansdown and AJ Bell, but you could use Halifax, and you could use Barclays. There's a whole bunch of others as well. But yeah, in terms of brokers, I use Hargreaves Lansdown, hl.co.uk, and AJ Bell as well. You can use others. You can use others as well. Okay. So yeah, that's it. I'm going to get going. And I will speak to you guys on the other side on the Telegram channel, and the people who come on. Okay, I will speak to you and work out the names that we like at the moment, and why, and what we're actually putting our own capital into, and why. And I'll probably share this. Stock should lead account, because actually whenever Gina writes anything, it's always rather good. So I'll probably share this with you, including the fair value model, and give you specific ones: equity positioning, COVID recession, etc. Because this will actually give us some good insights into which names they're putting out, and these are the names that we know the hedge funds are going to go back into, because they're all going to look at this data as well. So I'll share this with you as well, people. You can see some of the names there. And I own some of them already. Discounted stocks with low bankruptcy risk. We've got some of that. I'll share that with my apprentices, okay, and students. Premium stocks. Oh, good. There's some good stuff. I hadn't seen that earlier. So I'm going to share that with you. All right, everyone. I'm going to go now. They are not available in the US, are they? John, where are you? Are you in the US? Alpesh, I didn't get the brokers we can use in the US for the leverage. Oh, in the US, no, you've got even more choice. You've got, say, Interactive Brokers as a broker. Charles Schwab, E-Trade, TD Waterhouse. They'll all have access to leveraged stocks. They are available in the US. Most definitely, everything I say is available in the US. John, where in the US are you, John? I'm a big America fan. I worked in the US Congress about 25 years ago for Elliot Engel, Congressman Engel. So on the exchange trade funds, they'll just have different names, but they'll be the same. They'll have different providers, but they'll have double leverage. You just call up Schwab or whoever your broker is. Let me know who your broker is. Georgia, beautiful Georgia. I've been to Atlanta. The home of Coca-Cola was invented there, as you will know. So yeah, whichever broker you're using, let me know which broker you're using. Whichever broker you're using. I've got family in Atlanta, but I'm Indian. I've got family all over America. They will have those double leverage ones, but please read the risk warnings about leverage. It isn't as simple as, oh, if Apple goes up $1, I make $2, because if Apple goes down $1, you lose $2. And the way maths of it all works is you end up losing more money than making it if the underlying goes up and then back down to where it was. You actually end up net minus. Yeah, TD. So TD Ameritrade will be fine. Bharat Masrani is the chairman of TD Ameritrade, fellow Indian. He used to be my neighbor in St. John's Wood in London, and we know each other. He's a good man. So TD Ameritrade, yeah. They're good. They'll have all the stuff you need. You'll have all the stuff you need. Toronto Dominion. Okay, guys, I'm going to go. Thank you all. Apprentices, I'll see you on the other side. I'll share all that data with you as well, and the names that I like as well, and the spreadsheets and all the rest of it. So I want to thank everybody who's been on this call and this webinar. Thank you all so very, very, very much.